cryptocurrencies. How is everyone feeling about this as alternatives now that governments are starting to adopt potentially, ETFs are available, and kids think these are normal investments? David?
I think the kids think they're normal investments is actually something that we need to think very long and hard about. And I suppose in trying to understand crypto is to think about the whole value chain of crypto. So, you know, the old analogy, which I know is indeed very old, but of, you know, the gold speculators in California and the shovel makers, you know, that crypto is undoubtedly a revolution. And I think what's critical, I think, is to step back and just try and understand it and think about where that value chain works out, so there can be opportunities within the kind of the architecture, if you like, of the plumbing of crypto.
It's like blockchain technology, David.
Yeah, absolutely. Yeah.
Paul, is your digital wallet bursting at the seams with cryptocurrency?
I think certainly, you know, we think there's opportunities in this space. So we don't own any digital currency, so to speak, but we do have investments in areas where there's opportunities for those companies to make money off the back of digital currencies. To me, I think the real question is, you know, why do the consumers or younger people think it's worthwhile trading digital currencies? Well, you know, going back to the point made earlier, if you're losing 5 to 6% every year holding bonds, you know, what's the point in doing that? So I guess the bigger question is, where do people put their money if they don't want to lose it in the bond market through inflation? And so for us, coming back to trying to find those securities that have inflation-linked revenues, I think that's where we see the opportunity. And if you're investing on a mid to long-term horizon, you can take out some of that short-term volatility and perhaps have a portion of your portfolio exposed to inflation, given the backdrop that we see. So in our multi-asset funds that I run, the diversified and the multi-asset income, we've got about 12%, 10 to 12% in renewable energy, another 4% in infrastructure that have inflation-linked revenues. You know, this is just listed companies like Greencoat UK Wind or INPP, which invest in infrastructure and will benefit from those inflation-linked revenues. And the other part of that, of course, you know, nobody wants to touch these days, is that dirty, shiny metal called gold, where we think when something goes wrong in cryptocurrencies, people will come back to valuing gold as an inflation hedge.
Kevin, are you paying staff in cryptocurrency yet?
If only they'd take it. And you know, generally, that's one of the problems with cryptocurrencies. It's not acceptable. I'm pretty sure that no one on this panel would accept their wages in cryptocurrencies, nor would any advisors listening in accept their payments in cryptocurrencies. But fundamentally, it's not a store of value. In the space of the last 12 months, been as low as 16,000, as high as 69,000. This morning, it was about 58, and God knows what it is right now. You know, cryptocurrencies, it's basically 21st century gold. So if you understand gold, you understand cryptocurrencies, but gold's overvalued. You know, the price of any commodity is its marginal cost of production. And you know, go to Barrick Gold and have a look through their reporting accounts. They're producing this stuff for $1,000 per ounce. It retails at $1,800 an ounce. What's their response? Dig as much gold up as they possibly can. You take that to, let's say, Bitcoin is the one that everyone knows. Bitcoin's trading about 58,000. You can convert electricity into Bitcoins, and the cost of a Bitcoin in electricity is about $4,000. So it's currently about 95% overvalued. I'd sooner shoot myself in the head than put it in my portfolio.
Daniel, are you going to follow suit and shoot yourself in the head rather than?
Well, I don't want to shoot myself in the head just yet. But no, you know, at TSW here, we because of regulations, we just can't put cryptocurrencies in client portfolios. It's just too risky at the moment. When regulations change their mind, then fair enough. But I concur with what Paul is saying. We probably want to look at sort of crypto-linked performers, and anything with got a higher correlation with inflation. We're looking at things like that, and anything that produces like Nvidia, that's, you know, some of the mining attributes there. We'd be looking at those sort of areas, but to actually buy cryptocurrencies in client portfolios, no, we can't do that.
What about you, Alistair?
Well, I think David and Kevin have sort of hit the nail on the head with this thing. At the moment, because you can't transact in it, and hardly anyone will actually accept it as a form of currency, it's therefore very difficult to value it beyond just a, you know, as potentially a hedge in inflation, but is then the right value of Bitcoin 30,000 or 20,000 or 50,000 or 60,000? And at the moment, the thing is largely just driven by sentiment and weight of money. But I think the critical thing is that you can see that strategically it is a threat, absolutely, and you can't now uninvent it. And you can see that the global central banks are really struggling with this, because it fundamentally threatens the structure of the fiat economy. That's actually what it does. One of the definitions of the nation state is that you issue and control the supply of your own currency, and this is a direct threat, because there is nothing standing behind it. It's you know, I mean, they're all very different, but if you take Bitcoin, nobody owns it. I mean, you own the Bitcoins, but nobody actually owns the process. This is the ultimate in the democratization of currency. And you know, variously, you've seen people like the Chinese trying to ban it. That clearly hasn't worked. And now the sort of broad consensus among central banks and how to respond to this is to develop their own digital currencies: digital pound, digital dollar, digital euro, whatever you want. The question then is, what are you actually trying to achieve with that, other than it being digital? But I think the key thing, as Kevin alluded to there, is that these things will develop undoubtedly, but the critical thing in terms of being able to value them rather than just simply able to punt in them is when you can actually start transacting in them, because then you actually have an exchange rate which is which provides that store of value or not in a currency.
Interesting. Okay.
Dan, can I just come in on Alice's point there?
Yeah.
Yeah, you know, I'll say, kind of like pose the question: what are you trying to create with a central bank digital currency? Imagine you're Andrew Bailey right now. You're trying to work out what's going on in the economy. Imagine being able to watch every single transaction within your currency.
It's very powerful, isn't it?
In real time. So I absolutely, you know, the future certainly seems to be central bank digital currencies. And whilst you can't regulate cyberspace, or you can't ban the cryptocurrencies, you can't regulate cyberspace, but you can patrol the perimeter. And actually, you know, that transaction between metaverse and the real world universe, you can patrol that perimeter. And I think, you know, fundamentally, you'll be forced to use central bank digital currencies, and the cryptocurrencies will be outlawed.
Yeah, you're absolutely right. And you know, if you go back over the last 150 years, but particularly the last century, you know, what has been the driving force behind global power? It's been energy. In particular, it's been oil. Moving from here, it's data, and you've hit the nail on the head with things like cryptocurrencies there, because that gives the state through the central bank the ability to monitor every single transaction. They will know everything about what you do. Yeah, that is real power.
And the method of enforcing that is you'll be forced to pay your taxes in those digital currencies.
Yeah.
Interesting.